thank you.
If you could just confirm that it's recording though, I'll do this. If you could reconfirm that.
Done.
This is on.
Like something was like, what's the best song? So like it doesn't work.
Tell me growing up, our
Please turn to page 501. And in the Act are table C5 on page 47, and you can figure out the Roman numerals of it. XLVII. So we're still talking about active business income earned by a CCPC, and as you know, there are two rates. One rate has a small business deduction, the other one has a general rate reduction. And in federal terms, it's 15% is the general active business income, and that you'd find in table C5, general active business income 15%. Now to the left of that column are two columns that says small business income up to 400,000 and active business income between 400 and 500. As you know, we're not concerned here, you and I, with provincial taxes. We're only concerned with federal taxes. And you'll notice that the federal tax rate is 11% in both cases, right? And the difference between those two columns is a couple of provinces, particularly Manitoba is one of them, only allows its low tax rate, which you recall is 0%, on the first $400,000. So Manitoba actually has three tax rates. We have 0 provincial between 0 and 400,000, and then we start at 12% provincial, yet keeping 11% federal for $100,000 between 4 and 500. And then when we're over 500, it's 15 federal and 12 provincial. I've told you more than enough, more than you need to know. And I'm asking you to make this less complicated on yourself by drawing a line through this. So the column that reads small business income up to 400,000, just draw a line through that. and then write $500,000, or first $500,000, above the column that says active business income between 400 and 500. Or if you want, cross out $400,000 and put 0 and 500,000. I don't want you in an exam stressing out, oh, which column is it? Just use the last 3 columns and cross out the first one. And I've told you why, and now you can forget why. Now, active business is something you know already. So an active business includes an adventure in the nature of trade. Recall what that is from chapter 5, I think. Or someone who's actually carrying on an ongoing business, sort of, let's call it like a daily business. We've had some people try to take what they do and call it a business and incorporate it to take advantage of low tax rates. There was a famous court case in the 60s or 70s involving the coach of the, I think, Ottawa Rough Riders. So basically an employee who sets up a company because his accountant said the tax rate on companies is lower than the tax rate on employees. So if he was in, say, a 45% tax bracket, personally speaking, if he sets up a company, he's paying 11% federal tax plus whatever the provincial tax rate is. Total, that's going to be a lot lower than 45%. So the government came in with some new rules called the Personal Services Business Rules, which are referred to on page 504. Please turn there. So basically what that means is a person who would otherwise be providing employment services, according to the same tests that we had in Chapter 4, you may recall the integration test and the ownership of tools test, possibility of risk and reward, those tests. All those tests apply in this scenario. If it looks like your relationship is really an employment relationship, and you go ahead and incorporate a company to provide these services to your employer, you'll be denied the small business deduction. So you'll be paying tax based on the general active business rate. And as you know from our integration calculations, if you run through income through a corporation that doesn't qualify for the small business deduction, it's the general rate. Once you take it out as a dividend, you end up paying more tax than if you earned it personally. So this basically takes away the whole advantage of a person trying to get corporate treatment for their employment income. So personal services business, I might sometimes refer to it as PSB. If you see that in a company, that's code word for active but not eligible for small business deduction. Yes?
Consultants, would they be considered an active business if they have more than one client?
Yeah, very good question. Consultants, again, it's the relationship between them and they and who they work for, consulting is very much an active business. And if a consultant who's incorporated has more than one client, it looks a lot better like he's not employed by these people. A person who only has one client, it looks a little bit more like he might be employed by that client. So the more clients, the better. And this is actually something that has come up among some people I know who have indeed incorporated. And as I say, if they only have one client, their position is not as good. But ultimately, it comes down to those relationships and those tests that I mentioned, integration, et cetera, et cetera. You'd actually be surprised how often this comes up. I recall having seen it at least half a dozen times where people tried to sort of shoehorn this employment position into a corporation, and it just didn't work, and they always got caught.
So you're saying it's something CCA keeps tight?
Yeah, CRA watches this pretty closely, and probably their first or second question actually will be, how many clients do you have? And if you don't have a good answer for that one, they'll certainly ask the rest of the questions and probably get to the answer they want. Please turn to page 516. So, smart tax planners, if they have a company that has, say, $500,000 of active business income, they know that that income is eligible for the small business deduction, and that's great. But what if they have $2 million? As I said a couple lectures ago, often what's done is that they will bonus down. That's sort of code word for paying a bonus that takes them from $2 million corporate profit down to down to 500,000, i.e. a bonus of $1.5 million. So that's all that's remaining inside the company is active business income, taxed at the low small business deduction rate. But other tax planners have said, well, look at, why don't I just set up more than one company and just kind of arrange my business? Like if I've got 2 or 3 branches, I'll put one branch in company A and one branch in company B, and I'll have, say, 3 or 4 companies. Therefore, I should be able to have $2 million, let's say, of corporate income taxed at the low small business deduction rate. So we have a rule that says that doesn't work if the companies are associated. Now, you know what related means, right? So related starts with things like blood relationships and stuff like that. Associated is kind of like that, but it's more about control. Let's look at a couple of examples. So on page 517, diagram 1, company A controls company B, and company B controls company C. They are all associated. So A is associated with B, and B is associated with C. Interestingly, A only owns 36% of C. I mean, if you looked at A's relationship to C, A is actually a minority shareholder in C, indirectly speaking. But the way the associated company rules work, you look one company at a time. Do I control this one? Yes. Does this one control the next one? Yes. Boom, we're all associated. I'd like you to turn to section 256, please. By the way, as regards to Income Tax Act research and the assignment where you had to look at section 251, that's going extremely well. My compliments to everybody is picking up the right subsections and explaining why they apply. I really appreciate that. Good work.
Which part of 256 did you want us to look at?
Starting with,
Seems long.
it's very long. But let's keep it simple and look at subsection 1. So 256 bracket 1. So you remember the question from the assignment where you had to look at section 251 and explain, so these people are related because there's a blood thing, and then there's this thing and that thing and this thing. 256.1 is the equivalent of that. And I'm very fond of putting a 256 question on the final exam that's kind of like the 251 question that you've already answered on the assignment. So please get to know section 256 as well as you know section 251. Now I'll ask you to read this on your own time, but what I want to show you is that the word controlled recurs in section 256, and in particular 256.1, so many times, just to give you the idea of what's involved here. Association is really about control. It's quite possible for two companies to be related but not associated. Here's an example. These are brothers. A and B are brothers. This whole thing's related. Everybody's related to everybody. But A-Co and B-Co are not associated. Because there's nothing in 256.1 that associates them, because A, well, all he controls is A-Co, and B, all he controls is B-Co. So they are related but not associated. Now, I've just showed you, if you're following on page 517, if you look at diagram 2, now these companies are associated. So I replaced a brother with the same person. A controls both companies. Both companies are associated. If you look at diagram 3 for a second, so it makes the point that two corporations are associated if they are both controlled by the same person or group of persons. X and Y are just two people. They're not related people or anything like that. They're just two folks. But they constitute a group for this purpose. And the group controls A and the same group controls B. It's important to note because neither X nor Y controls either A or B. I mean, like there isn't one super control person here. But the Income Tax Act makes us sort of group two people together, unrelated folks, just people. Makes them into a group and says the group controls A, and if the same folks control B, then they're associated. So my ask of you is to look at these diagrams all the way up to 7 and have 256.1 open at the same time and try to match up which diagrams you think match which provision of 256.1. The one I love best is on page 518. It's diagram 4. I'll replicate it on the board. So X and son of X. These two companies are associated. And it's not because of a group thing or anything like that, because, well, there's really only one group. I mean, this company is controlled sort of by son of X and X, but actually it's really controlled by X. But there's a rule that says if X controls one company, and he controls 25% or more of the shares of this company, which is controlled by a related person. The two of them are associated. Now I'm going to change these numbers slowly, and please watch carefully and see what I do. If I make this 100, and this 0, not associated. Even though they're related, there's no association going on because there's no cross control or anything like that. If I make this 20% and this 80%, not associated. If I make this 25%, associated. All of a sudden, just because we crossed a line here at 25%, and because these people are related, father and son, and because he controls this company, and he controls this company, this so-called cross-ownership test, 25%, all of a sudden makes us associated. And again, the result of being associated is that these two companies have to share the $500,000 small business deduction limit. So for example, if they run two separate businesses and this one makes $800,000 and this one makes $1,000,001, between the two of them, they can only deduct the small business deduction on the first $500,000 of active business income. And they have to agree between the two of them. They actually file a form that's signed by both companies that says, okay, this one will claim small business deduction on $200,000, and this one will claim small business deduction on $300,000. Back to 0 and 100%. Now each company can claim $500,000 small business deduction. Families are very careful not to trip this cross-ownership rule. I had a lot of clients that had exactly 24% and 76%. Husband and wife, or brother and sister, or father and son, or mother and daughter, or whatever. 24%. Because as soon as they got to 25, it was, oh crap, we now have to share the $500,000 capital gain, or capital small business deduction. Yes?
So it doesn't matter if the relation could be any relation then? It could be any relation between X and son of X, like it could be like daughter or...
Precisely, yeah. Any relation covered by 251.
Okay.
And what kind of dollars are we, yes?
Is there any rules as to how you allocate the small business deduction, in terms of the net income on one versus the other?
No, not at all. In our example, we had more than 500, they just agree between themselves. Obviously, if this company only has 100, that's the max it could take, but aside from that, there's no rules, it's whatever they agree to. Let's just review how much this is worth. So so we're going back to page 47. So in federal terms, if I've got $2 million worth of income in this corporate group, and if I'm restricted to having only $500,000, and I'd like to have another $500,000, what that's worth to me is $500,000 times the difference in federal taxes between 11% and 15%, which is 4%, which I make out to be $20,000 a year, plus the provincial tax as well, whatever the difference is in provincial tax between small business rate and general rate. Like, I'm here to tell you that there are people who are very happy to get a $20,000 per year savings if they can arrange their affairs to have what we call the multiplied small business deduction. So it's a pretty big deal. Going back to page 518. So diagrams 4 and 5 cover the 25% related ownership, which we call a cross ownership. And that happens either if the father, in this case, owns his shares directly, as in diagram 4, or as in diagram 5, if he kind of owns them indirectly by way of A owning shares in B. The same rule applies, because it's 25% A owning B, therefore A is associated with B. Now this gets just a little crazier in that we apply the same principle with groups. So D is controlled by one person, and then there's a group owning the other company. And E is there's a group owning one company and another group owning the second company. It's actually not that complicated. You just sort of work through the same issues. You realize that if there's a group, the group is kind of thought of as one person. And when you've got a related group owning one company and a related group owning the other company, if there's cross ownership there, then we're associated. And I'll just ask you to go through D&E slowly and see why this works, that the 25% cross ownership in both cases causes us to be associated. There's only one other constraint on the ability to access the small business deduction. So the first is whether we're associated. If so, we have to share $500,000 with the other companies with which we're associated. The other one is if we're a so-called large corporation. Please turn the page to 520. Sure.
On 519, in the middle paragraph between the diagram on the top and the bottom, it says, it should be noted that where corporation A is not otherwise associated with B, but both A and B are associated with C, then A and B are associated because they're both associated with C.
Everybody hear that? So if A is not associated with B, but both A and B are associated with C, so I got three companies.
How exactly would that work?
I'll try to think of a structure and let you know next time. But suffice it to say for the time being that if this company is associated with this one, and this one's associated with this one, even if this one's not associated, they become associated.
Well, and then it says that that C can elect not to be associated with A and B. So C can't claim small business, but A and B can each claim. Like, That's confusing.
And if C doesn't choose it, it says A and B can both claim the full 500,000, but they can't claim the full amount if C claims any of it.
Correct.
Okay.
Is that what
Yep.
it actually said? Okay,
So C chooses.
learn that, got it.
Yeah.
Then also be like it's in a joint venture or something, for A and B controlling C, and then they can choose to just take this. Yeah.
The structure I'll try to think of as an example of this, I think, is going to look something like this. I believe it was a W structure. I had a client where there were two brothers, and brother one and brother two, and each of them had a company, and I think they each owned 50% of a company, and I think this company owned this company 50%. And I think that these companies were not associated, but each of them was associated with this company or something, which made them all associated. And then one of these companies elected not to be part of that, and then these companies were able to claim the small business deduction. I think that's how it works, and I'll get back to you on that.
Okay, thank you. Sorry.
The page 519, the tenant structure, that A is B and B is C and A is C. My interest in this is not to actually get into that situation with you.
Oh.
What I want you to do is be able to identify more like diagrams 1 through 7. Are these companies associated? And tell me which part of 256 makes them associated. That's really what I'm after in this course for you. So I will show you what a structure would look like with respect to that 519 middle part, but I don't expect you to know that. Please turn the page to 520. So I might have just one company. Therefore, it's not associated with any other company. But I still might be limited in how much small business deduction I can claim. And that's if it is ginormous. Because they do call it the small business deduction after all. And if a company is so large, then the government correctly says, well, maybe we'll just tax all of the active business and commit at the general rate. And here's how they measure large. They measure it by the balance sheet. Taxable capital. Well, firstly, let's read the last paragraph. The rules for examining taxable capital are complex, and explaining them is beyond the scope of this text. So I don't want you to worry about how to calculate taxable capital. But I will tell you, and I do want you to know, that it's essentially the left side of the balance sheet. It's essentially the total of long-term liabilities and book equity. That's all you need to know about how to calculate it. Once you've calculated it, one refers to this table, which you don't have to memorize or even write in the Income Tax Act. But what I would like you to know is, below $10 million, there is no impact, no reduction of the small business deduction. So we're still cool at $500,000. But at $15 million, on a linear scale, on a straight line scale, it's 0. So you can work out for yourself what the equation is, that if, for example, you have $11 million, you should be able to work out, please, how much maximum small business deduction I can claim. And basically, it's if you go from 500 to 0 in $5 million, in $1 million, you're probably going to go from 500 to, I would guess, 400. Oh, I was right. And all you need to be able to do is express that as an equation and show your work. Any questions on active business income?
Is there something about selling property as a business, isn't business, active business income? Or am I imagining this?
I think you're imagining it.
Okay.
The only other type of income that a corporation can earn is property income. So we talked about active business income. Now we're talking about property income. Because a corporation can't earn employment income because a corporation is not an individual. And we saw that there's a rule called the personal services business that kiboshes us if we try to say that our employment income is active. So essentially all we've got is active and property income. Property income in a CCPC gets its own name. It's called SIB income. Specified Investment Business Income on page 501. And this is basically everything that you'd imagine. It's interest income. Last sentence on the page, therefore the property income referred to in this definition includes only interest, rents, royalties, and dividends from non-affiliated foreign corporations. You can set that aside. So if I talk about SIB income, or specified investment business income, you can translate that as property income earned by a CCPC.
And that's considered not active.
And this is not active. The closest thing within it to being active, turn the page to 502. Item 2, other property income, such as interest, royalties, and rents from real property, are considered active only if the corporation employs more than 5 full-time employees to generate that income. So it is possible to have like interest income that's active. If we were, I don't know, a credit union or something and we had more than 5 employees, that would probably fit into here. Or a rental income could be active if we had a rental corporation that had more than 5 employees earning rental income from, say, apartment buildings. But generally speaking, those types of income will be SIB income, that is income from property, only made active if we have a lot of employees, more than 5 full-timers, earning that income for the company.
Would it be eligible for the small business deduction if you had contracted out those services, or those that work to an outside company? Do you hire somebody to manage the property for you, do those kinds of things?
Good question. Would it qualify for active business income treatment if instead of employing 5 people directly by the company, we just simply contracted that work out? That would make total sense, but it's not allowed. We actually have to have 5 employees of our company carrying out that work. It's a really sticky rule. It's kind of a dumb rule in a lot of ways because, I mean, we're in the age of outsourcing. You know, companies take their non-core business and they farm that out and pay other people to do it for them. This particular rule requires 5 employees of our company, and they have to be full-time employees. If you had 10 part-time employees, that would not qualify. People have litigated that. They've tried to make the definition fit their situation, but more than 5 full-time employees.
Well, the reason well, I don't know this, but it would make sense that they don't allow that because it's like going against the spirit of the act, right? The whole purpose of this is to encourage small businesses, and that's why we start corporations if you are outsourcing everything.
That's true. I think that the government is sympathetic to the idea that some people are actually demonstrating some activity by having some actual people working on this business. I mean, what's more active than that? And somehow they set the limit at 5, and that's how it is. Just want to show you one other thing before we go. SIB income is taxed on page 47, so table C5. The column that says investment income you can write there SIB, SIB, and underneath that AII stands for aggregate investment income, which is essentially SIB income plus taxable capital gains. And that's where we'll pick it up on Thursday.
Aggregate what? Aggregate.
Aggregate investment income, which is SIB income plus taxable capital gains.
We're gonna watch them through and destroy the jet. Yeah.